Hello, everyone, and welcome to our first practice exam in Accounting 401. So I'm excited. So let's take this exam together. So what I did is I went to, do I have it? Let me see if I got it up. Yeah. Give me just a second. So I'm not to the screen I need to be. So, anyway, well, I'm not going to take the time. So practice exams can be found at the end. No, nope, no, nope. They're at the front. Hang on. I'm there. Hang on a second. All right. Ugh. Too many screens open. There we go. All right. So practice exams are at the top, or quizzes. All right. So there's the quiz. So this is the practice, not the actual homework quiz, because we can open and then. Oh, sorry. Optional practice. So here's your quizzes at the top. So don't take those. So optional practice exams are here at the bottom. So here's weeks 1 and 2, 3 and 4. So what I did is I went through and I looked at all the questions, and there's like a database of like, I think it gives you 10 questions at a time, but there's like a database of like 60 questions. So I might even encourage you to take this more than once. Take this practice quiz more than once, and then that way you're just getting much more exposure to all the possible questions and the style of question and that kind of thing. So, well, without further ado, let's just get on to it. So let's put that over there and let's bring that forward. Okay, so I just copied them all down in Excel, and I am limited in my screen as what I can show you. So we might have to be, yeah, we'll figure it out. Just bear with me. Get some popcorn, get your Excel ready, let's go. So, all right, so Mark, a single taxpayer, earned $64,400 in taxable income and $5,440 in interest from an investment in the city of Birmingham bonds. Using the U.S. tax rate for 2023, how much federal tax will he owe? Okay, so we know we don't have to worry about these bonds because they are municipal bonds and they are tax-free. So I'm going to bring the tax hopefully over there. Good, you can see that. Hopefully it's big enough on your screen you can see it. So let's look at the calculation. So, and so much for my little arrows. They've got a little too long. So I have these really big monitors and this little teeny tiny little screen that I can actually record on. Can't record on the whole screen. Okay, so he earned $64,400. So we're going to find the tranche, or that's probably not the the layer, the level that he can be in. So that 64,400 falls between the 44,725 and the 95,375. So what we do is we take the 64,400 and subtract out the lower amount here, 44,725, when we have a difference of 19,675. And so we're going to pay 5,147 plus 22% of the amount over 4425. So we figured that out already, which is 19,675. So 19,675 times 22% is $4,329 plus the 5,147. Add that together, and he owes a total of $9,476. Okay? Yay! All right, let's move on. Geronimo files his tax return as head of household, right? Different tax rate. So this one, he was a single taxpayer, so we use the single taxpayer rate, and then we have the married filing jointly, and we had the head of household, married filing separately. So, but anyway, so we got to make sure we use the correct tax table. All right, so okay, so his income is $74,400. So we're going to go over to the tax table, and we're going to fix my 74,400, so that's going to make him be in this tax bracket. Okay, so he's going to pay $6,868 plus 22% of the excess over $59,850, which is $14,550 times 22% is $3,102. Add those together, and you get $10,069. But wait, that's not what the problem asked. The problem asked, what is his average tax rate? So we take his total taxes and divide it by his total income and that way we get his average tax rate of 13.53%. All right, we having fun? We're having great fun. Let's keep going. All right, Leonardo, who is married but files separately, earns $80,600. His taxable income. He also has $15,600 from the city of Tulsa bonds, which we're going to ignore that. And his wife earns $50,600 in taxable income, which we're going to ignore because they're filing separately. She's going to claim her income on her return. But if Leonardo earns an additional $30,600 in taxable income, what would be the marginal tax rate on the extra income? So we have to figure out. So can you see all that? I don't think you can see all that. So we'll go over here so you can see all my calculations. Okay. So what we're doing is we're trying to figure out the rate on that additional $30,600. So this is the way we do it. Okay. So first of all, we figure out what the marginal income is, which is the additional. So he has total taxable income of 112. 100. Sorry. Let's do this. Let's just do that. All right. Sorry. All right. 111,200. All right, and then his base income is 80,600. So the marginal marginal income is that. Okay, so that's going to be our denominator. All right, so how do we get that $7,048 as our numerator? Okay, so we figured out what taxes he'd owe on the whole thing. Okay, 112, and then we go to the tax table, which is not even there anymore. So 112. So we're going to find, so let's go up, and he is married filing separately. So 95,000 to 182. So he's going to pay 16,290 plus the difference of 24% on the difference between 111,200 minus 95,375, which is 15,825. All right, so that's $3,798 plus the base amount he owes, and that gets you $20,088. Okay, so that's what what he owes on everything. Okay, then we're going to figure out what he would have owed if he just earned this amount. Okay, just earned the 30,600. So we are going to go up to the 30,600. Sorry. Where are we? All right. Okay. Hang on a second. Let me just want to make sure we get this right. All right. When I worked it, it was like piece of cake. So this number came from R51. Oh, that's why, because we need to move that over. There we go. 80,600, right? Minus, okay, so now we're just calculating the taxes on the 80,600. So we go over to the tax rate, and it's between the 44,725 and the 95,375. Okay, and then he's going to pay $5,147 plus 22% over the difference. So the difference is $35,875 times 22% gives you $78,093. Okay, so and we add that together, and we get so if he did not made this $30,600, he would have paid $13,040 in taxes, not $20,088. So we're going to take the difference of $7,048 divided by his incremental income to get his incremental tax rate. So, right, makes sense? All right, let's move on. Let's move back over here. Okay. So if Susie earns $758,000, yes, everybody should do that. How much will she pay as a single taxpayer? So, the tax table. So by now, hoping you got the tax table down. So 758 minus the lower amount in that tax bracket is 578,125. So she has a difference of 179,875, and there she's in the 37% tax bracket, and so 37% of that is 66 553 plus we're adding the 174 238 that she would pay if she had made the 578 125, and add those together, and she gets to pay 240 791 80. All right, Curtis invests 250,000. So this is sort of a trick question, and you need to just pay attention to what the question is asking you. Okay, because you notice I don't have a lot of calculation here in this one. Curtis invests 250,000 in the city of Athens bonds that pay 4.5% interest. Alternatively, Curtis could have invested 250,000 in a bond recently issued by Initech Incorporated that pays 6% interest with similar risk as the city of Athens bond. Assume that Curtis's marginal tax rate is 24%. What is Curtis's after-tax rate for the Athens bond? Now, if it had asked for the after-tax rate for the Initech bond, then we would have taken the 6% times 1 minus the tax rate, which we will do in some future problems. But it asks you for what is Curtis' after-tax rate on the city of Athens bonds. That it's a municipal bond, so he pays no taxes, so his after-tax rate is his rate on the bonds of 4.5%. Okay? All right. Oh, well, looks like we're missing a little of that problem. We need a little more information. There we go. Okay. All right. Jackson has the choice to invest in the City of Mitchell bonds or Sundial, okay, Incorporated, that pays 8.6%. Jackson is a single taxpayer of $165,500 annually. Assume that the City of Mitchell bonds and the Sundial bonds have similar risk. Okay. So, you feel like you don't have all the information, but you do. Okay. So you got to figure out the after-tax rate for the Sundial bonds. So we have the rate of 8.6%, and then 1 minus his tax rate. So where did I get that? 1 minus his, where did it go? 22%. Okay. And I figured that out when I go to look at the tax tables. Okay. So 1 minus 22%, so 78% of 8.6 is 6.71%. That's his after-tax rate. So that's what he would need to earn on the City of Mitchell bonds to have similar risk, and that's so the question is, what interest rate would the City of Mitchell have to pay in order to make Jackson indifferent to investing in the City of Mitchell and the Sundial bonds? And that would be, they have to be the same rate, so it'd be 6.71%. Okay, after-tax rate. All right, which of the following is not a factor that determines, so you've hit some softballs here. So if you've done your reading, you don't have any calculations. So again, I want to just encourage you to go through the exam and maybe answer everything that you know, like these kinds of questions that don't require calculations. Just get them out of the way, okay? And then that way, go back and then work on every calculation you have. But then if you're stuck, skip it and keep going, because it's better than to get more questions answered than fewer questions correct, right? So answer everything you know, and then go back through and spend your time on the more difficult ones. So hopefully you've got 2 screens. You've got a screen for Excel. You've got a screen for, and you've got your tax tables copied down already in your Excel file, so they're right there for you, right? So hopefully you just at your fingertips. So do things that are going to be time-saving to make you help you in this exam. All right, so let's go back and finish some of these softballs, okay? Which of the following is not a factor which determines the taxpayer's required whether they have to file a tax return? And so that would be the taxpayer's employment. If April 15th, I don't know why I doubled that, but it did, falls on Saturday, individual tax returns are due then on Monday, April 17th. Dominic earned $1,500 this year, and his employer withheld $200 of federal income tax for his salary. Assuming that Dominic is a single 30-year-old and will have 0 tax liability, he is not required to file, but he should file anyway to get his $200 back. Okay? Raymond's tax return was randomly selected for an audit. Which audit program likely selected Ramon's return for an audit? That would be the National Research Program. Okay. Basu received a letter from the IRS that gave him the choice of paying a proposed tax deficiency, or 2, filing a petition with the U.S. Tax Court. So he received the 90-day letter. Which of the following has the highest authoritative weight? That would be the revenue ruling. And next question, which of the following has the highest authoritative weight? Which is a legislative ruling. Okay, so the revenue ruling is right under the legislative ruling. And then next comes, or further on down, is the private letter ruling. So which of the following has the lowest authoritative weight? And that's the private letter ruling. Which judicial doctrine means that a court will rule consistently with its previously rulings and the rulings of the higher court and appellate court? And that is stare decisis. All right, Jamie recently found a favorable trial level court opinion directly on point for her tax question. Which trial level court would she prefer to have issued her opinion? That would be the tax court. If you got a tax question, that always works. All right, if the president vetoes tax legislation, Congress can override the president's veto with 2/3 positive vote in the House and Senate. All right, so hopefully you did your reading and those kind of things stuck, and you can go back and do those quickly, and now we've got more problems. So, all right, so chapter 3 is sort of time value of money, and I'm just going to rant here just very briefly that it just drives me crazy that Connect is still using tables, because I'm telling you, if you work for me and I'm walking out and you're looking at the tables, I'm not going to be happy, because what a waste of time, and how inaccurate, actually. I actually did use Excel on this, but you have to use the tax tables to get the right answer for Excel, but in the big picture is not the right answer. So, all right. So, if Julius had a 32% tax rate and a 10% after-tax rate of return, a $16,000 tax deduction in 2 years will save how much money in today's tax dollars? So we're bringing that $16,000 forward today to see how much money we would save. Okay, so we're taking the $16,000 times the 32% to get $5,120. Okay, and now we're going to go to the tables. Going to go to year 2, 10%, and there's a table of 0.826. Right? And we're going to multiply it, and it would save $4,229. But that's really incorrect, because the correct answer is $4,231. How did I get that? So I'm going to go up here. So if you've not used the Excel functions, they are so powerful and so stinking easy. It's just embarrassing. All right, so we're going to go to the rate, and the rate is 10%. Okay? All right, so there, I clicked on the rate, and the number of periods is 2. I typed that in, and the future value is, let's see, 381. So make sure I get the right 381. Right, $5,120. And when I put all that in and say okay, it says that my savings would be $4,231, not $4,229. So even though this is the correct answer, you still need to use the tables, or or maybe you'd go, close enough. I don't know, but I can't always guarantee that they won't have closer answers. So anyway, hopefully that was a little help for your time value of money problems. Assume that John's marginal tax rate is 17%. If the city of Austin bonds paid 9% interest, at what rate would a corporate bond have to offer John to be indifferent to the two bonds? Okay, so so if it pays 9%, we're going to divide it by 1 minus the tax rate. So 1, let's see, so let's just 1 minus on my formula bar up here, 1 minus 0.1717 is 0.83, divide that. So he would need a corporate bond to pay 10.84% to be indifferent between the City of Austin bonds at 9% or the corporate bond, because they'll be making the same amount after taxes on that corporate bond. We'll make 9% after taxes on the corporate bond. Okay. Assume Lucas' marginal tax rate is 22%, and his tax rate on dividends is 11%. So I put the 22 and 11. When I see numbers, I always put them down there. You never know when you're going to need them. You may not need them all. May need some of them. If a dividend-paying stock with no growth potential pays 5%. What interest rate would the municipal bond have to offer Lucas to be indifferent? So if we have a 5% stock right? And then we're going to do 1 minus the tax rate. So 1 minus 11% gives you 4.45%. So we would need a bond that paid 4.45% for Lucas to be indifferent to which investment. Assume that Will's marginal tax rate is 40% and his tax rate on dividends is 15%. So it's kind of like the same problem, but we take it a little step further, okay? If the dividend paying stock pays 9.6%, what interest rate must the corporate bond offer for Will to be indifferent to the two investments, okay? So what we have to do is take the 9.6% times the 1 minus the tax rate, 15%, 1 minus the tax rate, 8.85, and so that's our after-tax yield is 8.2%, okay? So now let's make sure, let's not be confusing. So it's the same number, 8.16%, okay? So if we take that 8.16 divided by his tax rate, 1 minus the tax rate, so that's 0.6, 1 minus 0.4 is 0.6, divide that by the after-tax yield, and we get, he needs a return of at least 13.6% to get an after-tax yield of 8.16%. All right, and we have our last problem. So I'm going to leave this up here because this is probably the most difficult problem that you'll get on the exam. And so it just this is incorrect. So pay attention so you get it correct. Okay. All right. So if Tom invests $135,000 in taxable corporate bonds that provide a 10% return before tax return, how much will Tom's investment be worth either 8 or 20 years from now when the bond matures? Assume that Tom's marginal tax rate is 35%. Okay, so 1 minus the tax rate is 35%. 1 is 65, sorry. His marginal is his tax rate, right? Tax rate, can't type, is 0.35%, and so this is 1 minus the tax rate, okay? So when we take 1 minus the tax rate on that 10% bond return, okay, what are we going to get? We're going to get 0.65, right? We're going to get the 0.65 right there. So I'm going to use that number, okay? All right. All right, so we're taking, so this is going to be, pay attention here. So this is the key to working this problem. So we're taking the 135,000 and we're multiplying it times 1 plus the interest rate to the exponent 8th year. Okay, so notice up here we have 1 plus 0.065, okay, and in parentheses, and then caret. You do use the caret on the above the 6. You use the caret above the 6 for the 8 years, and so his investment after taxes will be worth $223,424 in 8 years. And you're going to do this exact same thing. You're going to take 1 plus 0.065 in parentheses to the 20th exponent, caret above the 6, 20, all right? And so we're going to multiply those together, and then in 20 years it would be worth $475,692. So, all right, I hope this was helpful, and I just really encourage you to take this exam 2 or 3 times so you get more exposure. The more times you can take this, the better you're going to do on the exam. So reach out with questions, and I will see you on the next video.